Hello and welcome to the Pinnacle Financial Scribbles series. I'm your journey's host and financial disruptor, Adrian Harasymiw, wealth builder at Pinnacle Financial. Well, it's time for another Scribble session with today's focus on helping you better understand the basics of bonds. We're talking high level here as there are many details which we could needlessly get caught up in but aren't necessary for a general understanding. We just want to touch on enough for now to get you through your next financial or investment conversation without shuddering in despair. The bottom line is to get you comfortable with financial jargon so you can better build your family's wealth for a more unconstrained life. If nothing else, just remember how to spell bond. I-O-U. That's it. Of course, that is a bit too general, so let's take another step down the rabbit hole. Bonds are issued by companies and governments to borrow money from investors. The proceeds of these loans are used for anything from the daily operations of the entity to financing specific projects. In a bond arrangement, the borrower is known as the debtor, while the owner of the debt, or the investor, is known as the creditor or debt holder. In other words, when you invest in bonds, you become a creditor. Bonds are known as fixed income instruments. This is because they have traditionally paid a fixed rate of interest to the creditors. In other words, that means that as an investor, assuming the borrower did not default, you knew how much money to expect to be paid to you and when. To shore up your basic understanding of bonds, here are some more common terminology used in financial language, so it's best to have a handle on these two. First, we have the issue price. This is the amount initially borrowed by the debtor entity from the creditor. Secondly, we have face value, which is the amount to be paid back on the maturity date, usually the same as the issue price. Thirdly, we have maturity date. This is the date the final interest payment is due, along with the return of the initial amount borrowed. And finally, we have coupon rate. This is the annual percent interest rate the borrower will pay to the investor or to the lender throughout the course of the bond's life. Also specified will be the frequency of interest payments from the debtor to the creditor, such as annually or semi-annually, and whether the rate is fixed or variable. Okay, so let's take a look at a hypothetical example to help crystallize your understanding. Let's say we have XYZ Corp, which issues a $100,000 bond at semi-annually paid coupon of 5%, which matures 2 years from today. This means that every 6 months, the investor will receive $2,500. That's half of 5% of $100,000 or half of $5,000. In the fourth and final payment day, 2 years from now, the debtor will repay the creditor $102,500. In other words, the repayment will consist of $100,000 of face value and a final $2,500 coupon payment. Some bonds, once issued, can then be traded by the debt holder in the secondary bond market. In other words, if the investor doesn't wish to wait until maturity to remove the bond from his investment portfolio, he can sell it in the open market, where another investor will buy it from him. These are the types of bonds you are most likely holding, either directly or indirectly, in your own investment portfolio. That said, there are other bonds, especially those formed between two private parties. While they are likely more customized, these cannot be traded on the secondary markets to other general investors. Now, when it comes to privileges bestowed on a bondholder, it's vital to recognize that creditors do not hold ownership stakes in a company, at least not by holding a bond. That said, in the event of a corporate dissolution, bondholders are first in line when it comes to return of capital with any remaining money available in the company. In other words, the bondholder must be made financially whole before any money can be returned to the owners of the company. Now, this isn't to say that a bondholder is guaranteed to get all of his money back, but rather that the owners of a company won't see a dime of money back until the bondholders receive all of their money back first. The pricing of options as they trade in the markets, as well as other details about bonds, are beyond the scope of this Scribble session though. Perhaps I will cover these in other Scribble sessions in the future. So, be sure to subscribe to this Pinnacle Life channel to find your way back to more useful and easy to follow financial savvy. Now, to help get all of your new and growing financial knowledge organized in one easy place, head on over to www.mypinnaclelife.com, where I will send you your very own free My Pinnacle Life notebook once you've joined our Pinnacle Chronicles email list. Oh, and before jumping ship from this video, please press the like thumbs up button to let the YouTube algorithms know that these Scribble sessions are worth sharing with other financially weary people as well. And now, it's time to get ready to get your skin in the wealth game and on your way to the pinnacle.